Okay, Larry Buluro, the Director of Sales at Chapel Hill, Denham, is live here in the studios to have what you call the Market Watch discussion with us, with the Nigeria's Pension Commission ruling out the new multi-fund structure for PFAs. That is something that will be taken off on the 1st of July. So we've got about 30 days in between to get everyone to understand what this is all about, how will it work, what will be the impact on the market, on the equity side, whether it's mutual funds or you're doing rates or you did whatever in the market, whatever the asset classes you're investing. That will be session on the first part. Then we'll talk about the NIDF currently doing the third bond raising, 16.02 billion naira. Currently, the market, as part of the infrastructure fund, we've got to hear from him as the fund managers. Then, of course, we've seen a wobbling stock market since this year started. Now, portfolio investors seem to be exiting with the outlook on the general elections. But what will add some favor to the market? Will it be the IMTN IPO listing? Will it be Dangote and Lafarge all raced into the market to do rights offering as they look at Buhari's administration's multi-billion-dollar infrastructure spending? Let's have this Market Watch with Buluro. Good morning. It's good to have you. Let's start with a handshake. Maybe that makes you more comfortable because this is going to be a multi-structured discussion. Bring us up to speed on these multi-fund structures for PFA. Why is this important? Why is PENCOM putting a new structure in place for PFAs as to how they allocate funds? We have 8 trillion naira in the kitty as we speak.
Correct. So thank you very much, Bosun. You had mentioned earlier we're looking around the first week of July, and I think it's just more trying to match risk appetite of contributors to the products that's out there. So really what's going on, I mean, historically, about almost 70–80% of pensions money has been into fixed income securities. Now they're trying to match age profiles. They figure the younger you are, you have a better, much more risk appetite than a retiree. So they rather just, spread the savings into variable income instruments.
Okay, so basically it's about the age group.
Correct,
so
correct.
Try to look at the demography of the population.
Correct.
And say folks who are between 18 to 49 years.
Correct.
Unfortunately, I missed that group 1 or tier 1 by just about 12 months or
12
so.
months?
Yeah,
okay.
they're about. Yeah, they're about. So I just missed that tier 1. So I'm in tier 2.
Correct.
Which is the lower level.
Correct.
So which is the 26.5% for those who are older,
Correct.
like me, who cross that 5-0 level.
Sure. I mean, listen, I think we need to make it very clear what these variable income instruments are, right? So yes. It's more equities, REITs, private equity, infrastructure, and they're trying to diversify the asset class
yes.
for those age rates. If I might inform you, this might make you a little bit happier, you can opt in into Fund 1. So even though you missed by 12 months, you can call your PFA and say, you want to be put into that particular bracket.
Why would I want to do that? Will it be whatever? Will it be the market? Will it be the assets? Will it be the return on investment? Why would I want to up from tier 2 to tier 1?
Well, so in Fund 1, it's a bigger percentage that could go into those variable assets, right? So, and the return. Now, the risk profile, so you need to understand the risk reward of these asset classes. Yeah. They're volatile. Fixed income is predetermined. You know what you're getting every 6 months. You know what's going to happen at the end of the investment. As you know, you just mentioned earlier about how, quiet the equity market is, right? So it's about you understanding the asset class, you understand, I mean, also your risk profile. Are you, do you have the heart to, if you're going to be daily constantly watching your portfolio, is this what you want to do? But I think in the long term, for example, equities have been proven to, give positive returns, over a long period of time.
Why is these distinctions being made? Necessarily, is it trying to take a little bit away from equities or take a little bit away from the fixed income because of the way yields are behaving in the recent times and what the federal government is doing moving forward in terms of restructuring our treasuries portfolio?
I think it's more, the other asset classes also need investment. And the returns of those asset classes are also
So we're trying to boost other asset classes.
Well, we don't want to boost, but diversify your options, right?
Okay.
So if you look at the returns for some of these PFAs over the last, 4 or 5 years, they've been negative returns, be below inflation. And a major reason is also the fact that a majority of those investments are in fixed income assets. So, which last year we saw yields really, really high. But at the same time, over the course of the end of the year, we saw yields drop.
Okay, that makes some sense. Because if we look at mutual funds seems to have performed nicely in recent times. You folks have one of the mutual funds, which is infrastructure. I don't mind being part of that. You guys seem to be providing some decent return. So if I have a kind of a categorization or a multi-fund structure that allows me to be part of an infrastructure fund, I don't mind.
Correct. So this gives a pathway, which allows, gives the PFAs, asset managers, the flexibility to allocate savings into those different asset classes.
So how do we push this out? And the natural question is, how does it benefit the equities market, which is almost always the #1 destination and focus for anyone who is buying, whether from the outside or the inside?
Our expectation is once this goes live, you see more activity into the equities market. It's compared to the other asset classes, it's a little bit more defined. People know GT banks, Zenith banks, Dangote stocks. So naturally, we expect a migration into that asset class. Now, my engagements on the PFAs, some have actually hinted they've actually been in-house restructuring their portfolios. There was a rally we saw sometime last year where I guess maybe part of that went into. So you might expect muted activity, but expectation naturally is to expect activity in the equity space. But it's an asset class that's well known. Now, here, portfolio managers have to do extra work now, doing real research, deep dive analysis into what's the best stocks to buy.
So you see this as a near-term trigger, as some folks put it.
Correct.
As a near-term trigger for the equities market that's been significantly has been hurt so far in 2018.
Correct. Very, very possible. And the other asset classes are beginning. REITs, there's nothing exciting right now in that space. We mentioned infrastructure. We're seeing products coming up in the asset class. Mutual funds, which has been around for a very, very long time, you might see renewed interest in that particular asset class.
Perhaps some firms will package more.
Correct.
Of more mutual fund managed funds and throw them on the market and investors because they're chasing $8 trillion.
Yes, and this are going to be you probably see the mixed funds, mix of equity and fixed income. Not sure probably won't see much in money market funds, but asset classes that have a mixture of both asset classes into one fund.
And then bringing private equities or PEs into this looks like an icing on the cake, because if you look at what is in the news, Allianz, or the Swiss mega multi-billion-dollar institution is now taking a stake in Africa Reinsurance. If you're holding that stock right now, I'm sure you'll be looking at, hold on a second, this looks like something new, a fresh blood, new thing into Africa Reinsurance.
Correct.
That is good. That's news.
I mean, it's exciting for the private equity industry. I think there still needs to be more awareness, more education for in regards to the asset class, more engagement with the community. It's also a currency. Also, discussion needs to be had. A lot of private equity funds that we have, they're raising dollars. How do you you have a private equity fund that has Naira, and which I think will be a low-hanging fruit, and you might probably see our PFAs engage in such private equity companies before you start looking at dollar-driven funds.
But for now, it's good. If you're bringing in the dollars from the outside and you're investing in a mattress-making company or whatever it is locally, or it's making biscuits or whatever, or healthcare.
Correct.
I'm doing that from the outside. Well, that looks a lot. That is good for me. Or if it's for companies listed on the exchange.
Correct. I mean, again, you need to be able to match dollars, with given where the currency is today, right? So you bring in your dollars today, what will that dollar be, 2 years from now?
Okay, that's always part of the conversation. But let's change gear and move on to the NIDF. So, for you folks were looking at another 16 billion.
Correct.
Aggressively within 2 years or thereabout. This is the third capital raising.
Correct. Yeah. So we launched sometime in June. We have about a little bit over 11 billion Naira
out of a 200 billion package.
A program, yes, correct. So this is our third raise, and the way the fund is structured, we might be coming to the market possibly every quarter. So you might be seeing 3 to 4 raises every year.
Where's this money going?
Into infrastructure projects, and usually when we raise the money, max 2-3 weeks, we've deployed the fund. So there are projects in our pipeline immediate pipeline of almost 50 billion naira that we're currently raising money for, and as the money are raised, we tend to deploy the funds to these projects.
Talk us through this. Talk us through these projects. What projects are you funding? When we say infrastructure, looks very big. Explain that.
Correct.
Yeah, explain that first. Then we go to this chart.
Okay.
And we got this infrastructure, 10-year bond, and inflation.
Exactly.
Who outperforms?
Exactly.
Who?
So we look at a myriad of projects across different sectors, right? So we're looking, power, we're looking at gas distribution infrastructure, we're looking at utilities, PPPs, but currently pipelines, what we've deployed to right now, captive power, and we need to be very, very clear about when I say power. We're not looking at anything that has to do with the grid, has to do with anything NBET. We're doing captive to projects or companies that are providing power to corporates, grade A corporates. So off-takers are like Coca-Cola, BOA, Cadbury. Those are the kind of off-takers of these power projects. And it's 5-10 megawatts.
Makes it easy to sell and get your cash.
Very well. And the structures we have around some of these loans that we've given are very, very strong. Where we have first lien on the assets, we have lien on the shares of the owners of the assets. There's a 6-stage cash waterfall where before the entity actually touches the cash, interest is taken care of, principal is taken care of. The operators of the assets are also paid. There's also a dirt reserve account where it has to be topped up a quarter in advance before they actually touch cash to run the operation. So, and that's to protect our investors. Majority of our investors.
I call it firewalls.
Correct. So we have pension monies as our investors that we need to make sure that monies are safe, and they also get a return. I think one of the beauties of the fund also that every quarter we're distributing to investors cash.
I don't mind getting into that game. So let's bring that back up on the infrastructure debt and the FGI 10-year. If you're looking at the fixed income now, you're looking at the Naira paper, you're looking at 10-year as one of the most attractive to put your money in, because that puts you somewhere in the middle. You try to balance the long end and the short end of the market. So you go for 10-year. Technically, that's how it is all over the world, really. So explain this to us in terms of who is outperforming who.
So what's good? I mean, I won't use the word outperforming. We're just showing a trend of what infrastructure debt looks like and the return profile if you invest in this asset class. For instance, this asset class is built for long-term patient investors, like our PFAs. And really what we did was we noticed an average PFA's portfolio, there'll be a 10-year bond in there. And the return profile over the last 10 years of the 10-year FGN, I mean, mostly they've averaged double digits, but there's 2 occasions over that 10 years where it's underperformed compared to inflation around 09, 010, and if you remember, that was when CBN.
Inflation is the zebra line.
Well, yeah.
Inflation is the thick one. Infrastructure debt is
exactly the zebra line. So what it is the infra fund, for example, like our infra fund, what we price is around 300 to 400 basis points above the 10-year FGN. Okay. And what that zebra line is telling you now, over that long time period, only one time in the last 10 years. As you see,
somewhere around 2010.
Correct. And
if you remember, that's around 2010.
And if you remember during that period of time, right? The financial
meltdown.
Exactly.
And that drags out to 2010.
So the point of this particular diagram is to let you know that infrastructure gives you above inflation returns based on how it's priced.
Very interesting. Bring out the second one quickly, because we need to look at investment performance, and this is where I'm trying to balance on my portfolio.
Exactly. So what is here is just really showing you a risk-return profile of different asset classes, and you can see where infrastructure is. It's a safe investment with a very, very strong return profile. Where it sits. Now you see your equities, you see your private equity, great returns, but you can see on the part of the chart where it stands on the risk.
In terms of volatility.
Exactly. So, with infrastructure.
So you look at infrastructure almost at par with government bonds.
Over the long period of time, but yes, and risk profile is similar. So what you're seeing there is on par in regards to risk. Return, it's much more higher.
It's much higher.
Exactly.
Okay, so in terms of risk.
Exactly. I mean, your safest asset class, of course, is cash, right? You put cash unless someone doesn't steal your money. But the safest investment in regards to risk is government bonds, right? And you're seeing a similar risk profile for infrastructure.
I got it. Let's wrap this up and continue the conversation after the break for a few minutes about what you think, where do you think the Philip will be with everyone looking at MTN IPO? I got a lot of questions from investors. When is it coming?
Okay.
I'm going to ask Buluro when we return.